Okay, so good evening everybody. Welcome back to this session for paper number 20. So just give me 2 minutes and then I'm starting it. All right, so more people have joined now and this is good time to start. Initially, only a few were there. So if you try to recall, in the last session, we studied approaches of valuation. And basically there are three approaches of valuation. One is the income approach. Second one is the market approach. And third one is the cost approach. Just a quick review for those who could not attend previous session. Now, as far as income approach is concerned, there are many methods. So I told you in the profession of valuation, internationally, many standards are there. Are you aware that there is something called accounting standards and auditing standards and IFRS and Indian accounting standards? Just like we have standards in the field of accounting, we also have standards in the field of valuation also. Like there is one organization which is named as IVSC, International Valuation Standards Council. It has issued IVS, International Valuation Standards. Similarly, there is an organization named as RICS, Royal Institute of Chartered Surveyors. They have also issued valuation standards in Red Book. Similarly, we have in India valuation standards which are issued by the Institute of Chartered Accountants of India. ICI valuation standards are there. So if I compare all valuation standards, I come to the conclusion that there are only three approaches of valuation. One is income approach, second one is market approach, and third one is cost approach or asset approach. There are only three approaches of valuation, keep in mind. Now, as far as income approach is concerned, there are three methods. There are many methods of, you cannot you cannot decide that there are only so many methods for valuation. Approaches are only three, but there is no limit on number of methods. You can have n number of methods. But the popular methods are discounted cash flow method, option pricing methods, and multi-period excess earning model. Now, under the market approach, you have market price method and market multiple approach, and comparable transaction method. Under the cost approach, you have a replacement cost method and a reproduction cost method. So, in fact, in the last session, we tried to solve one question also for valuation. You can see it here. I said that under DCF method, how do you make a valuation? Number one, you need to estimate life. Number two, you need to estimate cash flows over life. Number three, you need to calculate present value of these cash flows. And number you need to make a sum total. This is how you can make valuation of an asset. Valuation of any asset can be done like this. So now let's come to your study material, that what does it say, and let's try to solve some of the questions from your study material itself, right? So I'll start from the beginning itself. Look at this chapter. So let me tell you, this is your chapter number. Just a minute. I request all of you to please keep open the study material in front of you so that we can make a discussion on this basis. This is your study note number 6, which talks about valuation model. In the last session, we discussed a lot of theories. So here we intend to solve some numericals. Okay. Here I go with the first one. So look at this. Illustration number 2. This is on page number 222 of your study material. Illustration number 2. Here we are talking about the market approach. See, there are 3 approaches and the second approach is market approach. I'll brief you quickly what is market approach. So if you want to make valuation using market approach, if the company's equity share are listed on any stock exchange, so this is called the market price method. You simply say, okay, so market price per share is 1200 rupees and number of shares issued by the company are 1 crore and therefore valuation of equity of the company is 1200 crore. So as such, you are doing nothing. You are simply taking the market price and multiplying it by number of equity shares, and you are saying this is the value of equity of this company. And this is also named as, this is also named as market capitalization. Do you know which one is the largest company in India from the point of view of market capitalization? Any answers from your side? Which one is the largest company in India from the perspective of market capitalization? Okay, so as such, no answers from your side. So let me answer this. And the answer is actually Reliance Industries Limited is the biggest company from the perspective of market capitalization, right? But this approach, the market price method, can be used only for listed company. How about making valuation of unlisted company? To make valuation of unlisted company, first of all, you search for a comparable company. Okay, so last time I gave you an example of cow, but let me tell you steps over here. First of all, I search for comparable company. Then I calculate market multiple for that company. Now, what may be the market multiple for that company? Comparable listed company, better I say. So suppose I want to make valuation of one unlisted company. First of all, I search for a comparable listed company. Suppose I am making valuation of a steel sheet manufacturing company. So I look for a steel sheet manufacturing company which is listed on the stock exchange, which is regularly traded over there. Then I calculate market multiple for that company. What do I mean by I calculate market multiple? Either I calculate price to earning ratio which is one of the most popular ratios, or I calculate price to book value ratio. You can try to guess the formulas because the name itself is formula, right? See, I'm not getting any response from your side. So, and everything is fine. Okay. So just type OK so that at least I know that you are there. Price to earning ratio, price to book value ratio, or enterprise value to sales ratio, or enterprise value to EBITDA ratio, or price to sales ratio. So these are some of the examples of market multiples. I search for a comparable listed company, then I calculate market multiple for that company, then I multiply multiply this market multiple with the parameter of unlisted company. Like for example, EPS of my company is rupees 10. Price earning ratio of comparable company is 20 times. So I take 10 rupees, this is my EPS, I multiply it by 20 times to arrive at fair value of equity share of my company. Or suppose the book value per share of my company is rupees 300 and price to book value ratio is say 4 times. In that case, I'll say rupees 1200 is the fair value for equity share of my company. So these are the steps to be followed. There may be more complications, but yes, this is the basic thing one need to follow. Okay, look at this illustration number 1. It says that earning per share of your company is rupees 2.5. The growth in earning in your company is 0. Cost of equity is 12.5%. Now you know that market price of any share is dividend divided by cost of equity. So dividend or earning in your company is 2.5 rupees divided by cost of equity 0.125. That gives you price of 20 rupees. Right? So one can, calculate price to earning ratio. The formula for price to earning ratio is 1 divided by cost of equity, which will be 8 times over here. So this was a basic calculation. Let's take a better example. Let me discuss more about the price to earning ratio. The formula for price to earning ratio is very well known to everybody. It is market price per share divided by earning per share. So suppose there is one company which is named as, now this company A has market price per share of 200 rupees while its EPS is just 10 rupees. So what do I say? That its price to earning ratio is 20 times. Same industry, you have one more company named as company B. This company has market price per share of 500 rupees while its earning per share is 50 rupees. So I can say that its price to earning ratio is 10 times. Now question arises, why is it so that one company has comparatively higher price to earning ratio while the other company has comparatively lower price to earning ratio, while both companies belong to same industry? And the reason behind it is growth rate. So if the future growth rate of a company is expected to be higher, then it will have higher price to earnings ratio. What does it mean? That even if your current earning is lower, say 10 rupees, still your current market price is very higher, say 200 rupees. So how is that possible? If my current earning is lower, why are people ready to buy shares of my company at a very high price? And the reason is quite clear over here. The reason is like this, because people expect that the future growth rate of this company will be very high. So even though it is not earning handsome amount as of today, but it is expected to earn the same in foreseeable future. In looking at future growth prospect, the current market price is high. So earning is low, still market price is high, and the reason is actually expected higher growth rate. Okay. Right. So now we have one question. And just a minute. The question is like this: estimate the PE ratio for a firm which has following characteristics: high growth phase and stable growth phase. Let me first tell you what is this high growth phase and stable growth phase. Look here, it says that high growth phase is for 5 years, while stable growth phase is forever. This is for infinite years. And the high growth expected is 25%, while stable growth expected is 8%. It means that the earning of the company will grow at the rate of 25% per annum for next 5 years, and 6th year to infinite year, earning of the company will grow at the rate of 8% per annum. Dividend payout ratio is 20% in the high growth phase, and dividend payout ratio will be 50% in the stable growth phase. Higher dividend payout ratio. Beta of the company, beta of the equity share is expected to be 1 and 1. Okay. And now what question is asking, that risk-free rate of return is 6% and risk premium required by the investor is 5.5%. So they have used CAPM model to arrive at the cost of equity, and cost of equity is here 11.5%. Now they have used a kind of very complex formula to calculate price to earning ratio. You know, if you look at this formula, you will feel that, oh my God, what is this? This is very complex. But if I broke it down into several steps, then definitely you will feel that this formula is not actually really difficult. It is a comparatively easy formula. It's not really very difficult. Okay, so let's break it down into several parts. We will do some valuation steps, and then based on that, we will try to derive this formula. Okay, so now this is the question. This is the situation in our hand. And let's make valuation of shares of this company on the basis of two-stage dividend discount model, and thereafter we will, just a minute, try to derive the formula also. Okay, so here I go. See, let's take one assumption. This is your illustration number 2. Let's take one assumption that current EPS is equal to rupee 1. Obviously, EPS means per share. Current EPS is rupee 1. Now, let's not look at the complex formula and let's try to solve this question in two-step model. In two-step model, what do we do? First of all, we make a table for 5 years because the high growth phase is for 5 years. And then we calculate earning per share, and then we calculate dividend per share for these 5 years. Now, if you have the question in your hand, it says that earning growth rate is 25% for first 5 years. So my first year's EPS will be 1 rupee multiplied by 1.25. And then the next year will be this amount multiplied by 1.25 again. And if I drag it down, this is my EPS. So EPS, I have assumed that 0 years EPS, current year's EPS is 1 rupee. And thereafter it is increasing at the rate of 25% per annum. So this is how EPS looks like. Now question says that payout ratio is 20%. Multiply this by 0.20. See, I'm trying to make a valuation by first calculating the cash flows. If you have any doubts, meanwhile, feel free to ask EPS and then DPS, and now you flows at the discounting rate, which is 11.5%. How come 11.5%? That we can discuss later. This 11.5% is actually calculated through CAPM model. In SFM, you might have studied it. RF plus RM minus RF into beta kind of thing. So this is how it is calculated. I will just quickly calculate it for you. You will have to use your calculator, obviously. Here I am using some Excel functions, but you just do it with your calculator. I'm also solving, you also start solving the same. So sum of present value of cash flows for first 5 years is 1.43. If you buy shares in this company will have EPS of 1.25, 1.56, 1.95, 2.44, 3.05, out of which 20% will be distributed in the form of dividend. So this is outflow for company, but this is inflow for the investor. Investor will keep receiving 0.25, 0.31, 0.39, 0.49, 0.61. And then you will calculate present value of these cash flows at the rate of 11.5% because the desired rate of return of investor is 11.5%. So sum of present value of future cash flows is 1.43. Now, 6th year onwards, the growth rate becomes constant at 8%. So then what do I do is I will use the Gordon's model formula. Here I am assuming that you have studied SFM subject. And in SFM subject, they teach you one formula which is called the Gordon formula. The Gordon formula looks like this. P0 is equal to A1, or you can say P0 is equal to D1 divided by KE minus G, or you can also write instead of D1, if I take D6, then it will become P5 is equal to D6 divided by KE minus G. So first I need to calculate D6, right? Let me tell you what is D6 over here. D6 means the dividend for 6th year. So first I have to calculate EPS for the 6th year. Look, EPS for the 6th year will be 5th year's EPS multiplied by 1.08 because 8% growth is there. So this is 3.30. And 6th year's DPS will be EPS into 50%. This is your dividend per share for the 6th year. Now take this 1.65 as 6th year's dividend and then divide it by cost of equity, which is 11.5%, and deduct growth rate, which is 8% per annum. And that way you will get 47 rupees as P5. 5th year's value, people name it as terminal value, is P5. The next step will be to calculate present value of P5 at the rate of 11.5%. And obviously with the 5 years factor, right? I'm using Excel, but you're not allowed to use Excel in examination. In the last session, I already taught you the keystrokes required to calculate present value. You know, otherwise also, you must have studied it in CMA foundation or intermediate level. So now allow me to say that this is my step number 2. Okay. And this one was my step number 1. Step 1, the sum present value was 1.43. Okay. And in step 2, just a minute. I found present value. So this 1.43 is representing sum of present value of cash flows for first 5 years. While this 27.32 is representing sum of present value of cash flows from 6 to infinite years. This is representing year 1 to 5, while this is representing year 6 to infinite. Now in step 3, I'll make sum total of these two numbers. Now look at this. This is 28.75. What is this? This is P0. That is fair value of the share at year 0. Now step 4, I would like to calculate price to earning ratio. Price to earning ratio. This is price per share 28.75 divided by earning per share, and current earning per share is 1 rupee, right? I have assumed it to be 1 rupee. So obviously the ratio is 28.75. So this is the full process of solving the question. And whatever is given here in the study material is just the shortcut. Isn't it amazing to derive this formula? Whatever is given in the study material is just the shortcut of solving the question, right? The full method is here. I'll try to do one thing. I'll break down that formula for you so that you can have a better perspective that how that formula. Look here, I've got 28.75 as the answer, as the value of the company. Price earning ratio is 28.75. And these people, they have also calculated price to earning ratio, but with a very complex formula. So what does it mean? Instead of applying the formula, if you follow this process, you will get the same answer. This process will tell you the logic behind this value. Formula is just the shortcut. Look at this process. What is this process saying? So you estimate life, which is infinite years. Then you estimate cash flows. So these are cash flows. And this is 6th year onwards. Then you calculate present value of these cash flow. For first 5 years, it is 1.43. And thereafter it becomes 27.32 and make a sum total. And then you calculate price to earning ratio. And these guys have used some shortcut. Look here. Just a minute. I'll just take a screenshot and I'll put it here in my Excel file so that we can compare this also, right? A minute, please. So this is what they have done, right? Just a minute. Just to have a quick comparison, I'll put it here. And also the exact formula which has been used, which looks like this one. Okay. Now we will also try to derive the kind of formula. We will also try to justify that what exactly are they doing over here. Look at this. See, what they are doing is 11.5% minus 8%. So in the Gordon's model formula, you did exactly the same thing. Look here, 11.5% minus 8%. So this is this part of your calculation in the Gordon's model. Value of cash flow. So I'll draw your attention to this. The formula for present value is you take future value and then you divide it by 1 plus the rate, 1 plus 0.115 raised to the power 5. This is how you calculate this present value of 27.32. 1 divided by 1 plus r raised to the power 5. So this is 1 divided by 1.115 raised to the power 5. Okay. Now here you see they have started it with 0.5. What is this 0.5? And then what is this 0.5? I'll tell you what is this 0.5. So 0.5 comes from here. See, actually not, this is not exactly 0.5. Let's take this. This is like 1 into 0.5. And then what you're doing is you are doing 1.25 raised to the power 5. 1.25 raised to the power 5. So your EPS in the first year was 0 year was 1 rupee. And then what do? 1.25 raised to the power 5. This will become your fifth year's EPS multiplied by 1.08. This will become your sixth year's EPS. Once you get sixth year's EPS, then you multiply it by dividend payout ratio. So this numerator is nothing but 1.65. This numerator is nothing but 1.65. Why don't you check it? Let's do it. So I type 1.25. 1.25 raised to the power 5 will give me 3.05. Okay. 3.05 into 1.08. This is 3.29589 into 0.5, that is payout ratio, 1.6479. If you solve the numerator, you'll get 1.6479. That is nothing but this 1.65, which I have used to calculate this 47.08 fifth year's value. So if you look at this part of the formula carefully, it is first calculating value at the end of fifth year using the Gordon's model, and then it is calculating present value of that particular value, right? Now come to the first part of the formula. In the first part, if you see, what exactly are they doing? So this is actually nothing but the formula for growing annuity. You know, in mathematics, there are many formulas. There are formulas for, this is actually formula for finite GP, sum of finite GP formula this is. So in that case, that is how it happens that this 2.25 is the growth rate. I mean the common ratio is actually 1.25 divided by 1.115. This is the common ratio. So this is 1 minus common ratio raised to the power n divided by this this thing, the cost of equity minus discounting rate. If you solve this part now, so this part is nothing but shortcut for this table. This part is nothing but shortcut for this table. Let's try to solve the first part. So I'll solve it for you. In fact, allow me to derive this. I'll give you a derivation for this. That may take some time, but thereafter, whatever is derived is gonna be very interesting for you. So what do? I want to calculate sum of present value of first 5 years. My first year's amount will be definitely the EPS, and then I will multiply this EPS. Two things are there. First year's amount, let's call first year's amount as A. First year's amount is actually A, and then there is a common ratio. First year's amount is A, and then there is a common ratio which is called R. So let me write it like this. Finite GP sum total formula, where A is equal to amount of first installment, and R is equal to common ratio, N is equal to number of installments. I hope you know the finite GP sum formula. I'm giving you derivation. So derivation for finite GP sum formula is like this. It says that you take A and then multiply it by, correct me if I'm wrong somewhere. Common ratio raised to the power n minus 1 divided by common ratio minus 1. Okay, suppose you don't have faith in this formula, na? I'll give you one thing. Formula for sum of finite GP. Look at this. Formula for sum of finite GP is equal to A into R to the power n minus 1 divided by R minus 1. GP is geometric progression. Okay. So just to give you more faith in the formula, I've shown you this. Now, the interesting thing over here is, I'll tell you what is the interesting thing. In our case, what is R and what is N? And later we will talk about A also at last. Our case, this common ratio is actually 1 plus the growth rate divided by 1 plus the cost of equity, which is actually discounting rate. Why 1 plus G upon 1 plus K is the common ratio? Because every year's dividend you will multiply, every year's dividend you will actually multiply by 1 plus the growth rate, and to calculate present value, every year's amount you will divide it by 1 plus the cost of equity. I'll prove it to you later. First, you need to believe that, yeah, whatever I'm saying, this is correct. Okay, N is fine. Let's talk about A now. What is A? So for the purpose of A, I will use terminologies of this formula itself. Here they are taking EPS 0 and the growth rate and 1 GN. Okay, G is the initial growth rate and GN is the later growth rate. All right. So I just want to use the terminology which they are using. So I'll take EPS. This is 0 years EPS. When I multiply 0 years EPS by payout ratio, I name it as POR, payout ratio, it will give me 0 years dividend. Now 0 years dividend, I'll have to multiply it by 1 plus the growth rate to arrive at the first year's dividend. Now I know A, I know R, and I know the formula. So I'll put it here. A will be replaced by this number, and then I multiply it by R to the power N. Now what is this? R is actually this number. So a minute, please. Sorry. So this is R to the power N minus 1 divided by R minus 1. See, this formula is used when common ratio is actually more than 1. Now in the denominator, I'll actually take LCM. In the denominator, I'll take LCM, and that way it will become 1 plus G minus 1 minus cost of equity. Whole divided by 1 plus KE. Now this plus 1 and minus 1 will be actually cancelled. Look at it here. In this formula also, G minus KE. Okay, it's KE minus G. So actually for GP also there are two formulas. In one this is R to the power n minus 1 upon R minus 1, and the other formula is 1 minus R to the power n. So there are two formulas. One is where the common ratio is more than 1, and one is where the common ratio is less than 1. So there may be actually two formulas for the same. Now let's compare this with this part of the formula. So EPS is there, okay, then there is payout ratio, then there is 1 plus growth rate. This part is same. R minus G or K minus G, that we can reverse, because what they have done is they have used this formula in this manner. There are two formulas for GP, in fact I'll say. So one formula looks like this: 1 minus R to the power n, and then here it is 1 minus R. So accordingly I'll modify this also. And here also this must be 1 minus R. So just give me a moment. So this will also become K minus G. Now try to compare that this 1 plus K thing will actually get multiplied in the numerator. See, there are, look here, there are two formulas. One is 1 minus R to the power n upon 1 minus R, and the other one is R to the power n minus 1 divided by R minus 1, depending upon the fact that whether the common ratio is more than 1 or the common ratio is less than 1. So finally, when I will solve this part, these two things will actually become equal, right? So what I'm trying to prove here is that this first part of the formula is nothing but the shortcut for calculation of sum of present value for first 5 years, and second part of this formula is nothing but the shortcut to calculate present value of terminal value. So this is the whole logic behind the formula. Now I request you to just do one thing, that solve this part and check, is it equal to 1.43? I will also do it with you. So you type 1.25 divided by 1.115 into 4 times equal to into 0.2 into 1.25. So this will give you 0.19270 in the numerator. Divide by 0.135. This gives you 1.43. Yes, it is. Try to solve this. I'm waiting for you for next 2 minutes. Try to solve this. Okay, so this was the steps for derivation. You can also try this. And in fact, just a little correction over here. I must tell you that the first term is not actually this one exactly. The first term is like this because in the first term, the 1 plus k must also be there. If I put this here, then you know this 1 plus k and 1 plus k thing will be cancelled out. Let me just do that for you so that you will have a better understanding of it. This 1 plus k and 1 plus k will be cancelled out. So these are the steps for derivation of first part of the formula, which is about sum of finite GP. Now, how is this a finite GP? If you allow me 5 minutes time, I'll prove that yes, this is a finite GP. So look, what kind of cash flow you'll have. The cash flows will be like this. If you want to make total a sum of present value of cash flows, look, the first year, your first year's amount will be like let's say first year's amount is EPS into payout ratio into 1 plus growth rate. EPS into payout ratio will give you DPS, but this is for 0 year. Multiplied by 1 plus G, this will give you first year's dividend. And then this is first year's dividend divided by 1 plus K. Okay, this part of saying it EPS into price to earning ratio, let me name it as D0. D0 into 1 plus G upon D0 into 1 plus G will give you D1. D1 divided by 1 plus KE will give you first year's present value. Now for the second year, what will happen? I'll tell you. Here you will take D1. You will take D1 and to calculate its present value, you'll have to do 1 plus KE raised to the power 2 because this is the second year. For the third year, you will do this, fourth year, fifth year. This is, this is your second year. This is your third year. Hence put here power 3. This is your fourth year. Hence put here a power 4. And this is your fifth year's dividend. So put here a power 5. And in fact, why to unnecessarily, we can simply write this one also in the same terminology. D1 upon 1 plus K raised to the power 1. So what are you doing over here? You're trying to calculate sum of present value of first 5 years dividend, right? So this is D1, D2, D3, D4, D5, and to calculate present value, you divide it by 1 plus K raised to the power 1, 1 plus K raised to the power 2, 3, 4, 5. Right, now this D1 can be replaced with this number. One is actually this, or better I call it D1 is actually D0 multiplied by 1 plus the growth rate. Okay, and then what is D2? D2 is also D0, but this time I multiplied by 1 plus the growth rate raised to the power 2, because this is how you get second year's dividend. You need to apply growth rate 2 times, then you get second year's dividend, then you get third year's dividend, then this is how you get fourth year's dividend, and then this is how you get fifth year's dividend, right? So that is what I'm saying. Now look at this. This is a geometric progression where the common ratio is 1 plus G divided by 1 plus K. And the first term is this. And here D0 is nothing but EPS into EPS multiplied by payout ratio. So I request you now to take a screenshot of this. I'll give you 2 minutes time. Let me zoom it out for you so that in a single screenshot more stuff will be covered. Take one screenshot over here. Uh-oh, I'm sorry. Looks like. Okay, let's do it in 2 parts. Take one screenshot. In fact, in this one single part, it will be done. So this is actually the derivation of first part of the formula. Right, guys? If you know the proper logic now, that is really important. If you simply cram this formula that, okay, come on, yeah, this is the formula, I'll put figures over here and I'll get the answer. And this is how I calculate price to earning ratio of the higher growth firms. That's not going to work out. You need to know the proper logic behind it. We done this question in a tabular manner and we got the same answer. And finally, we derived this formula also. If there are any doubts, feel free to post it over here. Otherwise, in some other session, we can discuss more about it. So that's it from my side. Thank you for being here. I repeat, if there are any doubts, feel free to post. Okay, looks like there are no doubts. Thank you very much for being here. See you. Bye-bye.